In the last week, we have seen a fairly mixed performance right across the S&P, but specifically on the healthcare sector, we do see quite a lot of companies that have been battered. We're talking just in the last 5 days, CNC down 40%, ELV down around 11%, and UNH under the spotlight today down around 2%. And that's something we're seeing a bit of a trend with year to date, many companies up double digit. The healthcare sector, for the large part, hasn't been that great. We're talking UnitedHealth down 40%, ELV down, Humana down, CNC down. Realistically, unless you were heavily invested in CVS or in fact CI, this industry has just really underperformed. And we've also noticed, even with a bit of a pullback from yesterday's extreme greed, now sitting in greed, investor sentiment is still pretty positive. Investors are still chasing stocks that we believe to be severely overvalued, and they've really started to neglect the healthcare sector, where we can see pretty much the whole industry, even CVS with the strong run-up, still looking undervalued and trading at forward Ps in the single digit, something we would say does at least deserve some consideration. And UNH itself is down 38% in the last 12 months. Year to date, as we highlighted, down around 40%, but over the last 10 years, if you were holding, you would still be up 145%, although having taken a significant short-term hit. And it's also one that wasn't that long ago trading at its 52-week low, and probably seems like many years ago now it was trading at its all-time high of $631. Now it's also one that both Seeking Alpha and Wall Street consider to be a buy, with roughly an average 4 out of 5 rating. And if we specifically look at the valuation in isolation, this is what we would say is a great example of a severely undervalued company, because you have two things in combination. You have a forward P of 13.4, which sits well below the 5-year of 20. Also, one of the cheapest it has offered to investors in the last 5 years. And then you also see the yield around 3%, the highest offered to investors, as well as the fact it's well above the 5-year average of 1.4. So in combination, this is definitely a screaming, severely undervalued company. And if we were also to take a look at this model, where it in fact has the blue tunnel, remember in between that does signal the fair price, we can see right now there is a big disparity between the lower end of the blue tunnel and the current value, something we have seen only get larger and larger pretty much around April, May. Again, all of these pointers are screaming UnitedHealth is severely undervalued. And you may think, oh, it's been undervalued for quite some time, but actually when we zoom out to the last 5 years, more often than not, we're talking from 2020 around to 2023, a 3-year stretch period. This company was actually the opposite, severely overvalued. And yes, it has had some time in a reasonable signal, but actually what we are seeing now for the first time is quite an extended period where investors, if they believe in the longevity of the company, could really be buying a strong company that will rebound, possibly 2x in a short period of time. Now it's worth just highlighting their latest quarter, where in fact we did see the largest drop in their share price, which we'll come on to, was up 10% year on year. This is not a small company. Its revenue in just one quarter is 110 billion. Again, 10% year on year increase, and their bottom line is up 7 percentage points. So not only are we seeing revenue increase, but also efficiencies. These two in isolation, straight away we'd call it a high quality company. And we are due to get their second quarter results on July the 29th, where a lot more information will be available for us to really understand the issues that lie within the company. On one hand, we could see some very favorable results and narrative from the CEO, where the share price could extend 10-20%. Or we could get the flip side, where we see a lot more issues coming through, and we could see this go even lower than its 52-week low. And we actually get analysts who sit on two sides of the camp. We have one side, like JP Morgan, who sees this at around a $405 intrinsic price. They believe this will outperform the market from here on in. We have Morgan Stanley, who are actually more bullish. They see this at $563 after we saw the transition in the CEO. Both of these extremely bullish analysts. And then we have those sitting in the other camp, like HSBC, who actually see this company intrinsically worth $270, seeing no real upside, no momentum to really add this to the portfolio, as well as UBS, who see this around $385. Yes, it is some some upside to the current value, but not in the region of the likes of JP Morgan and Morgan Stanley, who believe this company sooner than perhaps we think will go back to its 52-week high. Now, speaking about Analyst is one thing, but if we actually look at what insiders doing, and remember, insider buying is a very bullish signal, like the great Peter Lynch says. Insiders buy because they believe the share price will go up, and 2025, in just the last few months, as we'll come to show you, they were buying 32 million worth of shares, not something we've seen over the period. In fact, the largest buying was around 2019. And we can see here, insider ownership is very low at 0.3%, and we did get the 32 million that we've just highlighted, with some selling but very small in comparison at 2.7, and the buys were in Q2. We'll also show you, for full transparency, who these insiders were and what the dates were. The largest was in fact the CEO, $87,000, costing him around $25 million. We also got the chief financial officer spending around $5 million, and this is around the middle of May, to what we would say bullish signals. And as we've covered in previous episodes, we've also noticed members of Congress adding. Now, also considering buying and selling, we can look towards the institutions. 88% ownership, where they sold 36 billion in just the last year. They bought a lot more at 56 billion, and whilst we haven't received the full data set yet of Q2, we're noticing the continuation of the trend, more buying than selling, 59 versus 20 million worth of selling. If you want to keep going back to where we actually identify the reversal of the trend, you would have to go to Q1 2024, but very obvious and clear, not just in the most recent period, but also over the last year, institutions a lot more bullish than they have been bearish. We also can't be oblivious to the issues surrounding this company, something that continues to pile up as the months go on. If you remember, we had the executive murder, we had the cyber attack in 2024, and we also had the CEO step down, although this was classified as personal reasons, which does lead us to believe that there is probably something a bit more behind the detail. And we have analysts actually taking two different positions to this stock. We have one who believe this was a very spectacular downfall, not from just UnitedHealth, but also the CEO. And we have other analysts who actually believe this is just an isolated event and that the company will rebound, and in fact very sharply. As we saw, this is where the camp of JP Morgan and Morgan Stanley sit, and investors are really asking themselves the key question: what can this company do to really revive, really turn themselves around? And the first one, very clear, very obvious, is to deliver a very strong earnings beat when we do get those numbers at the end of the month. But we should also bring to your attention, especially if you are newer to the company, that there has been a lot of negative sentiment around UNH. In fact, you could argue this is one company that just continues to get negative sentiment right across the board. Even before this year, we have some instances where they have been accused of pressurizing medical staff to change patient status to do not resuscitate. We have the Wall Street Journal come out, in fact, and say that they're under criminal investigation for possible Medicare fraud, something they hit back on and actually said the Wall Street Journal were deeply irresponsible and that they stand by the integrity of their Medicare Advantage program. And we also have whistleblowers here saying that they secretly paid nursing homes to reduce hospital transfers. And again, they hit back saying after reviewing all the evidence during their multi-year investigation, the DOJ declined to pursue the matter. So this isn't a company that is starting to hide behind the articles. They're actually coming out for the large part and really going against what information is coming out, which you could argue to one extent is a fairly strong sign. It does give you some faith into the integrity of the company, but again, there will always be those questions. And if we look at the growth of it overall, they do get an F, so not the greatest, but year on year and forward looking, their top line is estimated to grow 8 to 9%. Remember, Q1 we just saw up 10%, and that is also around the same as the sector, only marginally in fact slower than what they have done on a historical basis. What probably lets the company down is EPS projected only 6%, although we will factor this in to our valuation model shortly, which is lower than both sector at 10 and their 5-year of 13. And from a valuation perspective, whilst they do get a C-, we are noticing this company is trading lower than the sector at 17, so you're getting a 21% discount. And as we highlighted earlier in the episode, you're also getting a discount to what the company has historically traded for at around a 33% one. Now, this is something that pretty much in unison, no matter which metric you look at, you're getting a discount right across the board. So against both their 5-year and the sector, you're getting quite a substantial and potential very attractive opportunity, something we've seen members of Congress buying, we've seen institutions buying, and we've also seen insiders add to their portfolio, and some analysts also reiterate the outperformance they expect against the market. Now, their profitability also looks very healthy at an A+. Yes, gross margin fairly poor at 22% when the sector sits a lot higher at 59% and their own 5-year at 24%, but what looks very good is their bottom line 5 to 6% because the sector overall is burning through cash, -2%. Their own 5-year average pretty much equal to where it sits now, and one thing we like is not only very large cash from operations, near 29 billion, but it is much higher than their 5-year at 25, and also we can see sector again burning through -11 million. Now, we should make you aware in terms of the next 4 quarters, they only anticipate one of them to be growth, with the subsequent 3 double-digit decrease to the EPS, a 75% track record, 3 out of 4 beats. However, most recent one, 9-cent miss, and if they do hit the EPS target for 2026 at $26, the forward PE will come down to 11.7, but just a flag here, they did in fact suspend their guidance for 2025, so as of today, this EPS estimate is a little bit unclear. It's also a fairly high quality company. Their free cash flow per share has been increasing over the longer term. Granted, we see a dip into 24, the expectation is to increase over the next 12 months. We see very healthy sales growth, in fact nearly double digit for the majority of the years, 8% in 2024, and from a numerical basis, they have nearly tripled their top line, whilst also returning excess cash through some share buybacks, which is nice to see. This company has also historically increased the dividend at a double-digit rate, although their most recent one was a little bit disappointing in the mid-single digit. ROIC also very strong in the mid-teens. As always, we want a minimum of 10% there, just to give us faith management are able to effectively allocate their capital. Operating margin, whilst it isn't above the minimum, as we saw, this industry as a whole, their margins aren't the highest. Good to see UNH, one of the better ones in this category, and free cash flow pretty much straddling around the minimum 5% that we want to see year on year. Then the final one here, the net debt to EBITDA, below 3 is what we want to see. Numbers you note below, number of years it would take UnitedHealth to pay off all of their debt net of cash on hand. Also correlates to the balance sheet strength, 1.2 on the trailing 12 month, little increase over the next 12, so for the large part, balance sheet also looks fairly strong. It's always good to compare the performance against others in the sector of a similar size. We have ELV, HUM, CNC, and what we really want to identify is UNH's drop of 37% something in isolation, or are we just noticing weakness in the sector? And it is the latter. We can see weakness. UNH down 37%, ELV down 33%, Humana down 35%, CNC down 50%. In fact, the majority today have been down, and significantly on a yearly basis. If we were to zoom out over the last 5 years, not the best performers in the industry as a whole. You're probably better off picking any other industry during this time frame. But over the last 10 years, we do see a little bit of a difference. For example, UNH up 188, we get ELV up 150, MOH up 216, but understand past performance is not really an indication of how they'll perform. We could see UNH perform a lot stronger, or in fact much worse. Given their drop, it's also interesting to see whether they've been outperforming the S&P. Clearly over the last year the answer is no, down 37%, including dividends reinvested. S&P up 12, and if we were to zoom out over the last 5, again no, UNH up 10, S&P up 98, and even when we zoom out now over the last 10 years, not something that we actually noted not that long ago, but now with that 40% drop, they have marginally, you could argue, underperformed the S&P, up 187, S&P up 202. Now, before we get to our valuation, we just want to let you know we have released our latest free weekly article. We draw on every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of July, lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to our valuation, where today intrinsic price is $407, the average of the 4 models that you see. And because it is a deeper dive, we're going to take a look at the inputs and the outputs. Model number 1, Graham's valuation, where we have the EPS, long-term growth rate, AAA corporate bond yield. We get an intrinsic value that actually sits below the market price, hence the overvaluation. Bear in mind though, we don't look at any one of these models in pure isolation. We then get to the multiples valuation, companies similar sector and size as we just highlighted, average P multiplied by the EPS of UNH to get another overvaluation signal. And then we get to the dividend discount model, where we have the year-on-year increases, and we can note most recent one, bit disappointing at 5%, given on average it has been double digit, 12% in the last few years. Moving forwards, we've got a bit more conservative at 6%, and we've got our first undervalued signal. And then we move on to the discounted cash flow model, free cash flow year on year, average growth at 14% over the last 10. We've got a lot more conservative at 7 with a discount rate. We've then got the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 642, indicating undervaluation. Intrinsically though, the average coming to 407, and remember, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for UNH or any others. But we're not done there, because given the current price, we want to apply an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode today, a buy at $366, then we keep going till it's near the current trading price. Now at a 30% MOS, it would be a buy at $285. At 25 though is pretty much where we see this bang on today. 25% margin of safety. Wall Street themselves on average, although as we highlighted earlier, some analysts a lot higher, some in fact lower, $400 equating to 32% upside. Now give us your thoughts whether you see this now as a buy, hold, or in fact avoid. As we said, 30% 285, 35 around 264, and for those that want to see it, the 40% 244, but right now just 25%. Let us know your thoughts overall on the company, and don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in a Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.